Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Dollar General. The symbol is DG. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Lindsay Bell, Chief Investment Strategist with Ally Invest.
Well, Lindsay, we can see a lot of red in the markets today, and we have a big earnings week coming up. What do you see going into this week in the markets?
Yeah, this morning we are seeing a lot of red. In fact, it is, as of this taping, it's the largest drop in the S&P 500 that we've seen since March. So a day like today can feel a little bit scary, but if we dig down and look at what's driving the action this morning, it's a lot of the same stuff that we've been talking about for the last several months. The key driver today, of course, is coronavirus cases, which over the weekend hit a new daily high on Friday and Saturday. Over 83,000 cases were reported. That's the highest that we've seen going back to the July peaks. So that's a little bit scary as we're now entering the winter months. And the concern is that the flu is going to come through and there's going to be a lot of uncertainty between coronavirus and the flu. Who knows if you can get both at the same time? And with numbers ramping up this quickly, this early on, the concern is what does that mean for the economic picture over the next several months? We're also learning that in Europe, countries like Italy and France are moving towards sharp lockdowns again, too. So the concern is, again, here, is that going to be something that occurs here in the US and really puts a big dent into the economic activity that we have here? We don't believe that something like that will happen before the election, but the election is only 1 week away. And of course, that's another big uncertainty for investors this morning. With 1 week left to the election, we've been talking a lot about how volatility has increased and it has remained stubbornly high. Actually, this morning, you see the VIX index, sometimes known as the fear index, reaching high levels that we haven't seen in several weeks or months. So there is that uncomfortable level of uncertainty in the marketplace that is related to the election. And of course, stimulus talks haven't done anything to help either. There's been a lot of back and forth between Congress and the White House. And it seems like we're unable to come to a deal. I'm not probably going to hold my breath until on getting a deal before the election next week. But I do remain hopeful that we do get a stimulus deal by the end of the year or early next year. And I think that's something the market is just starting to price in right now. And that is that stimulus isn't coming till much later than hoped for. And so all of that coming together is driving the market action that you see today. So you see the S&P 500, the Dow, and the NASDAQ all down sharply. You see, here's a chart of it right here now. And the question is where do we go from here? It can be, again, like I started this conversation, it can be pretty unnerving to see the market start a week with action like this. But one thing that I will say that the market's always fallen back to over the last couple of months is technical analysis. And that is something that while I'm not a pro technician, I know enough about it to look for signs that I need to look for. And so what we're seeing this morning is you see this red line on the chart here that is going from left to right. That's the 50-day moving average. And today we broke below the 50-day moving average. That had been a nice level of support for the index, and breaking below it is certainly not a positive sign going forward, but it's only one day's action. We'll see where we go over the next week or so. It's interesting though, too. So below the 50-day, we just broke below that. After that, I'm looking at correction territory for the S&P 500. So correction is a decline of 10% or more from the most recent highs. which were in early September. So the correction level is 32.22. So I'm going to keep my eye on that. Hopefully that will be at the very least the next level of support, but it's pretty far down there, as you can see that horizontal white line showing kind of where that is right now. So those are the two areas that I'm going to be keeping my eye on. I want to see if we can stay in this 50-day area, hopefully break back above it. I'm not surprised that we've broken below it, given all the news that I just went through. If you look at the action the 4 days prior to today, we saw the market really consolidating on that back and forth within Washington about stimulus. And so we were really primed to bounce either up or down, and coronavirus is taking us to the downside this morning. But again, all that being said, these again are the same concerns and issues that we've been dealing with the last several months. When I think about what 2021 has to offer, things look a lot better from an earnings perspective, from a corporate profitability perspective, from a consumer perspective, as the government, I do believe, will jump in and support the consumer and the economy going further. So I do remain optimistic, especially in the longer term. So please keep that in mind when you're investing and you're looking at your accounts today. Keep your long-term plans in place. Please don't let your emotions take over. All right, Brian, I mentioned the VIX. I think we should get into that a little bit today. It's remained stubbornly high. What's the action?
Well, we've been talking about the VIX every single week here on the stock play of the day. And the reason why we're talking about it so much is that it's pertinent, that it actually is telling you that the marketplace is nervous about this election and everything that's going on, even though we remain lofty in the levels in the S&P 500 index and the NASDAQ. We're not setting new highs, but we're closer to the new highs than to the lows of the March lows after the pandemic announcement. So when I look at the VIX here, some of the things that I'm going to point out, we are down today, and we made a pretty decent size run up in the actual VIX index, the VIX. It's up $4 today at 31.61. But as you mentioned, stubbornly, the November futures contract, which obviously contains the election or expires after the election, that vol has stayed right around 30% for just steadily around 30%. So this election has shown a lot of nervousness in the marketplace. When I see vol levels that high in that November futures contract, to me, that means a lot of people are using the S&P 500 index as an insurance product. If you look at the open interest of the out of the money puts, they are much higher than the out of the money calls. So in my mind, when people are buying a lot of those puts, it's not necessarily speculation. It's more of an institutional based index, and you're seeing a lot of people running for protection. And as people buy up those put options, that's what increases the price of those option contracts overall, which the only way that that happens is when we jack up implied volatility. And we're seeing that in November. It's just staying right around that 30%. We're even as high as 29% going out to January of next year. December is also right around 30%. So these are all the futures contracts in the VIX index. And this is where the current VIX is at. Now, granted, the VIX is higher today, and that makes a lot of sense considering what's happening in the markets and all the red that Lindsay was talking about. And I also wanted to point something out. Lindsay talked a lot about the S&P 500 index chart. I'm going to draw a little bit of a trend line here. And the one thing that she pointed out that I thought was really interesting were these 4 days of consolidation. And basically, that was everybody waiting to see, is the S&P 500, or is the government going to come through and actually do what they say and pass some stimulus, or are they just going to keep saying, oh, come back tomorrow, we'll do something tomorrow. And what has basically happened over the weekend, in my mind, is that it was consolidating, waiting, should we break to the upside, or are we going to break to the downside? And we did get the break to the downside, which is bad news overall for the marketplace. Obviously, when markets go down, most people are not happy about that scenario. Maybe some short sellers would be. And then we also broke through this little 50-day period all in one day. So if we stay below that today, that's not a good sign for the markets overall. And it's just basically saying that people are not believing in Congress, saying that they're really going to pass this stimulus bill before the election. Now, not meant to be a recommendation by any means. We always never know what is in Congress's mind and exactly how it's going to play out. but we're a few days away now. You almost get into the days and versus weeks to the election period, and that is obviously being shown in the VIX index. All right, Lindsay, let's talk a little bit about today's stock, Dollar General.
Yeah, today we're going to look at Dollar General. It has, historically been a value play and has done usually pretty well in periods of uncertainty and periods of economic downturns. So, but before I get into the fundamental story here, I want to remind our viewers that we are going to take your questions live at the end of the show. So be sure to type out anything that's on your mind in the chat box on the right, and we will get to it at the end. We'll get as many questions in as possible. But let's look at the chart of Dollar General. Today, it's down just like the rest of the market. There's not really a lot of green in the overall market. This one's down, but not as bad as the broader index is today. You do see on the right-hand side of this chart a drawdown in the market, or excuse me, not the market, in this stock in particular, in Dollar General. It's down about 5% since that more recent high that we hit in October. But on a year-to-date basis, look at this chart. I mean, it's pretty phenomenal. It's up 37% on a year-to-date basis. Looking at the trend lines, it's still well far away from its 50-day moving average. These guys don't actually report earnings until early December. The retailers tend to lag on the reporting schedule because their earnings calendar is about a month shifted from everybody else because of the all-important holiday selling season, which we're going into for these guys. I will say they've had a good couple quarters over the earlier part of this year as demand has increased for their products. They offer low-priced goods at unbeatable prices, I guess you could say. So in periods, like I said at the top, periods of uncertainty, or when people are losing jobs, high employment, low GDP growth, Dollar General and the other dollar stores usually fare pretty well in that type of environment. Now, I will say their most recently reported quarter, which ended at the end of July, they saw same-store sales increase 18.8%, which is a pretty impressive number if you think about it on a year-over-year basis. So investors were pretty pleased with that. They also, at that same time, said that they were going to increase their stock buyback program by $2 billion. You're not seeing a ton of companies right now even buying back shares, let alone increasing their programs. And Dollar General is one of those guys. So that's a pretty strong sign from management and the board that they think this thing can continue along, and that its value, where it's valued right now, is below where it can go. So that we took as a positive. I will say, looking at some of the other details in the quarterly report, gross margins continue to expand, and that was really driven by the sale of less promotions because they're seeing more people in there. They don't need to promote their stuff as much. Their inventory is in good shape, so they don't need to get rid of stuff off their shelves. They also are selling much more non-consumable products categories, which just in general come with higher margins, which is a benefit for the company. And then there's, like I said, been a reduction in markdowns, which is positive for their profitability. Now we are getting to a place, though, which is probably why you're seeing the stock pull back a little bit here. We're getting to a place where the rubber's going to meet the road for Dollar General. And that is that when they do report their next quarterly earnings, everybody wants to know what were same-store sales, how is spending going within these stores. They have plans to continue to open more stores next year. They're even going into suburbs of more affluent communities where they're going to try to serve those types of customers for the first time in a long time. And so the question is how is spending going? Because they've benefited significantly from those stimulus checks that went out at the start of the pandemic, as well as the increase in unemployment benefits for those individuals that had lost their jobs. Those benefits have dwindled, and the unemployment benefits ended at the end of July. So the question is, are consumers still spending in the stores? How do they feel about spending? Maybe they're holding off until the holidays. We're not sure, but management is going to be able to give us some insights December about that. So I think that's why you're starting to see the stock pull back a little bit as investors get a little nervous because they're uncertain about their consumer at this point in time. But overall, I think given the fact that uncertainty is expected to continue, this could be a big winner for the holiday selling season. The consumer is going to be value oriented, they're going to be price savvy. These guys always tend to do well when the consumer is feeling that way. So we'll be keeping an eye on it. And I think the paper trade that Brian's put together today reflects all of that. So, Brian, why don't you get into it? But before you do, just remember, everybody, ask us your questions over in the chat box on the right hand side.
Yeah. So I'm going to start by mentioning that back in the day, back in June, we did talk about Dollar General. June 15th was the actual date. This is where the underlying stock was approximately at. We're going to call it 185 just to make life simple. And what we looked at back then was a little bit of the same we had about the same type of outlook in Dollar General, considering what was going on in the marketplace. And they were considered essential. They were a business that was opened and had already been determined that they could continue to do business after the announcement of the pandemic and a little bit of the bounce back. So we looked at a leap option, and we specifically did a leap option followed with a call option that we sold short. That's called a fig leaf inside the options playbook. So now we're looking at a little bit of the pullback. So we've had a good solid run up. And it was just a nice run up in the underlying stock. We had a little bit of a blip right here back in September. But then we had even a stronger run up to the upside. So now we're seeing a little bit of a pullback. So the concept will be today that we're going to sell a put option with the intention of buying that stock at a later date if we do get that pullback. So it's one way that we can target a buy price in the underlying stock. Now, I want to always emphasize that when we're talking about these strategies on the stock play of the day, they're not meant to be a recommendation. We're trying to learn. So we're looking at situations where some of the strategies from the playbook might apply. Now, the concept here, though, is more so how does this strategy apply to the conditions of the marketplace? So because of that, a lot of people might go on out and look at just selling a put. Selling a cash secured put means that I'm willing to buy that stock at that strike and I have no protection. But I don't like that in this marketplace because the markets are so volatile and we have this big election that is coming up shortly. So one of the things that we like to look at is selling a put, saying I'm willing to buy the underlying stock, but then I'm going to buy a put a little bit lower that will protect me in case this volatility comes true in the marketplace and we see a big downturn just in the marketplace overall, which obviously what my conversation about the VIX index is kind of showing that nervousness is there. So that's always a potential. All right, so inside the Ally Invest Options Playbook, I'm showing the short put strategy. We're selling a put at strike B. Underlying stock will be somewhere up here. Here's the stock price at expiration. That's an expiration graph for the strategy. So it's hanging out somewhere up here on the x-axis. We're going to sell this put saying that if it comes down to this level, we're willing to buy it. But we're really nervous because what if it just blows all the way through and goes all the way down here, right? We're going to buy some protection here, and we're going to give up a little bit of our credit to get that protection, but then we'll have limited and known downside on this underlying. So let's get into the strategy. Let's look at it. Here's the Ally Invest option chains. And we see right now that, let me scroll up a little bit, that Dollar General is down about 1.5%. So it's kind of feeding into the strategy that we're looking at today. When you have a down strategy on a stock that you wouldn't mind buying, based off of the outlook fundamentally for the underlying stock, then this strategy is something that you're going to be interested in looking at. Before we did the long call, where we were a little bit more bullish, so we went a little bit out of the money, or I'm sorry, a little bit deeper in the money and bought a surrogate for owning the stock. Today we're going to say if this pullback continues, we wouldn't mind buying more. It's a totally different aspect to it, but that's why we're looking at this short put spread. So we're going to go out till the November 13th expiration. Now we're going to go after the election, but we're going to have this expiration date before the earnings event. I do not want to be into a short put spread going into earnings. I wouldn't mind owning the underlying stock as much as trading options. But when I get into an earnings that's a known event, then volatility is really going to skyrocket And I would rather either be in the stock or not be in the stock relative to what I think is going on in the marketplace before that earnings event. So if it does come down, our goal is we wouldn't mind buying 100 shares at a lower price. So the stock right now at $212, down $3 on the day. We're going to look at the November 13th expiration that does not contain earnings. It's 18 days away. We're going to sell the 205 strike put. Here's puts on the right side in our option chains. And then we'll go down $5. We'll limit our risk, and we're going to buy the 200 strike put. That's going to be our protection. So in this instance, we can get this 5-point wide spread done for a net credit of 68 cents to the account. So if I do this trade, and we'll put this over here in the right rail. Well, the market's moving right now. It's already bounced. It's bounced quite a bit on us. But if we do this trade, it was 65 cents, 20 cents just kind of moved against us. I would want to work it a little bit more, because if I look at this, all of a sudden there's a wide bid-ask spread. I don't know what has happened in the market. Let me look. 1 second. That's the thing about doing a live show. These quotes are moving as we speak. So yeah, we got a really wide bid-ask spread on this one. All of a sudden, somebody must have lifted a bid on this option contract. So I'm going to definitely want to work this a little bit higher, and I'm going to actually say I want to get at least, let's call it 60 cents for sure. I'm going to go 75. 75 is solid. So we're going to say we want to do this for a net credit of 75 cents to the account. If we can't get filled at that, I don't know if I want to do this trade. That bid-ask spread on the option contract that we were trying to buy has just moved a lot. So I'm going to want to at least get a 75-cent net credit to this account by selling this put spread. Then my concept is, if I sell this, and we're going to look at it in the profit and loss calculator here. Let me remove our paper trade on the right rail. All right. And if we sell this put, then we're saying that if that underlying stock comes down to that 205 level, we'd be willing to buy 100 shares at that level. If it continues on down, we have some protection. And from 200 on down, we can't lose anymore. So we're getting enough of a credit on the 205 that we can actually buy the 200 and limit our risk and still receive a decent credit for selling this 205. And if we go back and we actually look at the chart here in Dollar General, kind of see that right around this level, we had some consolidation here. We also have the 50-day moving average. This is a level that I wouldn't mind getting long this underlying stock as. But once again, not meant to be a recommendation. We're just doing it on paper and trying to learn here on the stock play of the day. But I'm sure that generated a lot of questions. So if you have questions, please put it in the chat box in the right rail. And Lindsay, do we have anything that we would like to address today inside that chat box?
Of course, we always have a couple things to address, right? I'll start from the top here. Capital, here, Cat, Pace, Bell, the long name there. What tools are your favorite to look up options to review, Brian, outside of the LMS platform?
What tool? Well, I guess my tools overall, the thing that I always want to know is news. Most of all, I always want to know when earnings are going to be announced. And I always want to know when a dividend is going to be paid, because these definitely affect your option prices. And I'm going to do different strategies if there's an earnings announcement, and I'm going to be in that strategy around earnings, as opposed to if there's not an earnings announcement. So that's the biggest thing to me for option traders, and probably affects even more so than the underlying stock, is the actual news events and dividends. Dividends also, especially if it pays a big dividend, that's going to inflate put prices relative to call prices. So news is very big to me. And then there's one way that you can always figure out the news, and this is also interesting, is that looking at volatility charts on the option contracts, basically a weighted index of volatility on that underlying stock. And usually that will give you insights as to if there is news, because you'll see a spike up in implied volatility relative to the historical volatility. So those are the things that I like to look at whenever I'm trying to pick the right strategy for this specific underlying stock. And I do say that because I do get the question a lot where people will say, what's your favorite strategy? I really don't have a favorite strategy overall. I like to look at what's going on in the marketplace and then apply the strategy to those conditions and the pricing that's going on within those option contracts.
Yeah, that's a fair point.
Mhm.
We do Rag Piano chimed in and said he thought the S&P 500 chart looked like a cup and handle was forming, not perfect, he says, but it kind of coincides and reinforces with the comments that I probably made on the long term basis, and I can see what he's saying in that chart. What do you think, Brian?
Well, I'll just mention a little bit. I'm not a master chartist. I'm not a CMT, chartered market technician type thing. But what we did kind of see here was we did start forming a head and shoulders, an inverted head and shoulders, and we did mention that on one of the stock plays of the day. And my crosshairs are kind of highlighting the neckline of that head and shoulders. But today you can say that, yeah, maybe we are. This was forming a little bit of a handle. But what I would have liked to see more to finish that pattern is a breakout today to the upside. We got to break down. And to me, this was, you can look at it on the chart and just say, well, this is what it's forming on the chart. But now let's talk about the real world. And it's the uncertainty of the physical stimulus that Congress just can't seem to get past. And we had these 3 or 4 days of consolidation, and then we had a breakdown today. So overall, maybe it's still forming it, which means it would have to start consolidating again. But the breakdown to me today on the chart is a little bit more nerve wracking than what the pattern has been overall in the S&P 500 index.
All right. Well, Brian, we got a comment from Wayne. He said we did a great job last week at the Future of Investing conference. For any of you that did miss that, we had a conference on Thursday, digital conference on YouTube. You can go to to our YouTube page. I think it's ally.com/replay, if that's correct. Rewatch /rewatch to see all the videos and all the great speakers that we had. So it was a great time. We learned a lot, got a lot of insights from our speakers and from our very own internal experts. So thanks, Wayne. I think that'll do it for the Q&A today. We end a little bit early, but we appreciate you guys watching. And don't forget, though, you've got to tune in on Friday at noon to see Brian go through this trade after 5 days of trading. He's gonna run through the Dollar General trade, recommend any potential adjustments in the Stock Play of the Day Overtime show. Check it out.
All right. And I want to thank you all for coming. And please click subscribe and ring the bell so you get all the alerts for the Overtime show and next Monday's Stock Play of the Day. Thanks for coming, everyone.